Talk more about the banks and the recent sell-off. Joining us now, Macrae Sykes, Gabelli Funds portfolio manager. As time has gone on, just talking to Rick Santelli and others, Macrae, we're looking at this as now sort of as a carry trade unwind, not necessarily anything that onerous about the U.S. economy and I guess the banking sector. Is that what you think?
Yeah, well, I mean, 2 weeks ago I was here. We talking about how great the banks were doing, reporting season, capitalization, buybacks, et cetera. And so they're all doing pretty well. Good feedback. Fast forward, now we're talking about Fed hikes, emergency meetings, recession, carry trades. Fed cuts, excuse me. So I don't think that, even though the stocks have sold off, I don't think the fundamentals have changed in 2 weeks. No. There was a little bit of a perfect storm, too, over the weekend with Buffett selling some of those securities. You know, he still owns $35 billion worth of Bank of America, a lot of other financials as well. So, that gets included in the mix. But, I stand today, I like Wells Fargo a couple of weeks ago. Now it's a little bit cheaper, 1.2 times forward tangible book value. I believe in kind of the American tailwind of prosperity, and I think they'll do well, and so it's another opportunity to buy.
You don't think at this point that the labor market is weaker than we're aware, or that it could worsen more quickly than we think? That's not in the cards.
So, we look at stocks on a bottoms-up basis, and, I don't really get into the weeds in terms of the economy.
So not macro.
No, we follow that, and look at rates and so on, but in terms of analyzing one particular data point from jobs is not totally important to the work we do. What I would say, though, is that just the feedback we've gotten from the banks in terms of the trajectory, they're also reserved for higher unemployment of 5% by the end of the year. So there's some expectations of that movement in unemployment rate. So not terribly unanticipated as far as credit and all that concerns go. So it's one data point.
At this point, in terms of consumer credit or I don't know, loans, none of that is signaling a worse slowdown than what the Fed has tried to orchestrate, a soft landing.
Yeah, I think that's correct, just given the trajectory and the feedback we've gotten in July as well. Okay. And then, just to talk about that, too, this lower 10-year rate over the last couple of days is you've started to see the mortgage rates come in, 6.25 yesterday. And so that secretly will be an injection of good opportunity for the housing market. And that's a benefit to the banks as well that are owning AFS or owning MBS securities. And so that will help book values. That will also help refinancing and the whole housing market.
Do you think that the 10-year, it can be almost things can get out of hand and it can go further down? I'm talking about the yield. And it's more of a psychological, because we take that seriously. When you see money rush into the 10-year, you really do start to question everything you think about everything else. Is it possible that gives a false signal?
Absolutely. I think if we just look at the expectations for rate cuts, January 1st, the forward curve was 5 to 6 rate cuts for 24.
Yeah.
By May, it was 1 cut.
Now we're back to 5 or 6.
Now we're back to 5 to 6 within 2 weeks. Right. So, I mean, predicting all this stuff is really difficult. But I will say that, with inflation sub 3%, Fed funds rate 5 3/8, that's constraining. Tight. So from our perspective, on a longer-term basis, you'll think that the yield curve will eventually normalize, and that will be good for banks.
So are we back to 25 in September and then another 25 before the end of the year? Is that all we get? Would you bet on that? I'm not going to ask you to stake your life on it, because I wouldn't stake it on anything for the Fed.
I mean,
is that it? 50 basis points this year, that's it?
I think the longer-term trend is definitely down. When we get that, maybe it's important to some people. I don't think it really is important to J.P. Morgan's earnings over the next 3 months, 4 months. So I think the trend is good. I think inflation is good, and ultimately that would be good.
Okay, so your favorite is Wells Fargo still?
Correct.
Okay, but J.P. Morgan, just in terms of book value, is too expensive, or you buy that? You buy all of them? Buy a basket?
No, I think on a price-to-value basis, Wells Fargo is a great opportunity here. J.P. Morgan, still trading over 2 times book. Great execution, absolutely well-positioned kind of for the fundamental growth in the economy. but a little more valuable at this point, fully valued. And even Jamie Dimon has talked about pulling back on repurchases.
So Buffett does a lot of things based, I don't know what he's always thinking, but if Bank of America is definitely going up, it makes no sense to sell it, does it?
Well, there could be a number of reasons that they're selling. I mean, he talked about at the May meeting, wanting to get ahead
a
of
long time, though, right?
Potentially higher corporate tax rates, and they have huge embedded gains in the stock. So,
right.
Perhaps in doing, and there's some probably legacy planning for the other managers as well. So, may not be a priority. So there could be a number of reasons that he's selling.